And welcome back to Bitcoin Advisors channel. It is Friday. It is bright. It's early. It's too cold for California. And what do we always say? Great weather, bad politics, bad politics. And yep, I might still be asleep here. It's still pretty early, but what happened? So not only did the S&P and ISM manufacturer numbers come in a little bit hotter than expected, we had some economic data come out this morning, which suggests inflation is quite not gone yet, as the PPI month over month, well, it just came out hotter than expected. Consensus was 0.2%. We came out at 0.3. In a couple of minutes here, we may have the Michigan consumer sentiment and inflation numbers. I might check in on that at the end of the video. So let's jump into it here real quick and just talk about Bitcoin on the 4-hour, following up on what we were discussing yesterday. Is we had on the 4-hour this range, and yeah, we said, you know, more likely to range than not. If we did lose this level at 16,700, very likely going to move us down to about 15.7. And if we break to the upside here, taking out this wick at about 17.4, or 4-hour closure above 17.3, very likely gets us a move. It's really easy to get the next target in the short term here, which would be about 17.8 or 17.7. We could get a wick up there, certainly. And what does it have to do with Mr. Dollar? So dollar is putting in a bit of a bounce, as we said on the 4-hour yesterday, likely to come down and test this trend line as long as we do not lose the 103.66 region. We're looking for a bounce in the dollars, more likely than not, which would essentially hurt risk assets. So that's the current setup. However, if the dollar does lose this region, I am looking for Bitcoin to take a pretty large run, but at least come test the breakdown region of around 18 to 18.5. And there is potential for more, as 5-day volatility would be beginning, 5-day stochastics, the momentum indicator, would be crossing to the upside alongside volatility still expanding here. However, it still does have a downside posture, and that will not close for another 2 days and 9 hours. And typically the first test of the 9x exponential is a rejection, and we haven't quite gotten there on the weekly. And we were saying, more likely than not, a bounce is going to take place on the higher term time frames. What else did I want to bring up here? So yeah, the dollar is pretty much the same level it was at. On the weekly, we are going to close the week here today, and weekly Stokes will cross up above 110. So we have another week, and this is going to be a critical region for the dollar on the weekly if we start to lose this green 55. So we'll be keeping an eye on that. Volatility is still maxed, and momentum is to the downside, right? So I do imagine when this finally does flip back around on the weekly time frame, well, you can see the last bounce was quite significant, and that was coming in from the lows down there in May of 21. Believe it, back then the dollar was at 89 bucks. Here's another interesting article I wanted to touch on, because gold, as the dollar has come down, right, you'd expect gold to play in the opposite direction. Gold is denominated by the dollar on the world market. So when the dollar goes down, typically gold goes up. And there's quite a bit of news surrounding this oil situation. And anyways, I found this article pretty interesting. And I'm just going to line up a little bit of a target here for gold based off the hidden bullish divergence. There's several drives. So what is hidden bullish divergence? That's a continuation of the uptrend, which I'd say actually we went into a bit of a downtrend, but let's take a look here at what this would look like. There's one, perhaps two, I would say that's 2. Here's 3. So basically, if we can get a weekly closure above this pivot at 1800, that should give us a shot all the way to the top side of the range at 1950. And I would mediate that with that dollar starting to lose that 103.66. Again, not financial advice. I'm not a financial advisor. Might as well check on silver. Silver follows gold, typically more gains. And if silver does take a run to the top side of the range here, you know, we're talking 20 to 28%. Not bad. Actually, from today's level, we're talking about 20% if we get back to the top side of the range. And then it is a question of lower, higher, not. And the more times you come up and attack a price level, the more times you are going to start to make it becomes weaker in a sense. Lastly, oh yeah, so here's the news for today that I thought was pretty interesting. So we had this article came out on Kitco, and it says, if Russia accepts gold for oil, gold price doubles to $3,600 an ounce, says Credit Suisse Zoltan Pozar. So it says, in a year of unthinkable macro scenarios, Credit Suisse Zoltan said it's not improbable for gold to double to $3,600 an ounce. Pozar said that the year-end money market liquidity crunch is unlikely unless Russia decides to accept gold for oil in light of sanctions. While this outcome might sound out of this world, it's not far-fetched given some of the geopolitical macroeconomic surprises from this year. Pozar said in a note, oil, gold, and LSO crazy. Yes, improbable. No, this was a year of unthinkable macro scenarios and the return of a statecraft as the dominant force driving monetary and fiscal decisions, Pozar wrote. So in a sense, here's where it gets interesting. It says, if Russia responds to the recent introduced $60 a barrel oil price cap by asking for a gram of gold for 2 barrels of crude at the current market prices, the cap of 60 a barrel for Russian oil equates to the price of a gram of gold. Interesting, right? Take, you know, how many grams are in an ounce? There are, did my phone just die? No. My phone just died. Well, it looks like we're going to finish the video down at the bottom part of the screen, but so essentially what it says here is if the current market price cap of $60 a barrel of Russian oil equals a gram of gold, what essentially happens here is the U.S. pegs Russian exports at this price, and Russia in turn pegs a gram of gold. And this would come at the time when the U.S. is working to refill its strategic reserves with cheap petroleum. So remember, Joe Biden just drained our strategic reserves. I think it was down to from almost, 700 million barrels down to 400, something in that range. He really drained it. And if the dollar effectively gets revalued versus Russian oil, Pozar said, basically, if the West is looking to bargain, Russia can give the West the West a deal they can't refuse, right? A gram for more. If Russia countered the price peg $60 with an offering of 2 barrels of oil at that peg for a gram of gold, gold prices would double. And this is how gold can get to $3,600 an ounce from today's level at $1,794. And I'll, mediate that with gold. Gold can rip to that upside target if the dollar wants to fall. You know, if the dollar begins to fall, and it sounds like it may be beginning to be forced out as the world reserves currency. So that's just something to keep an eye on. Other than that, I think we check in on NASDAQ and S&P. Obviously, they're going to come down as we get some negative news showing that, hey, what Powell's doing, it might not be working. And we're pretty much in the same area as we spoke about yesterday. If we lose the 11,500, again, I'm looking for more likely than not the bottom side of this range to get tagged, and the same thing's going to go with the S&P here, getting us down to about 3,500, and the Dow. I think it was a bear market rally, going to come back down eventually. All right, that's it for today, guys. Have a blessed and highly favored day.